Good afternoon. Welcome, Real Estate Raw. This is Bill Ham. This is our regular Wednesday session. Today I've got something special. We're going to be talking about the top 10 most asked questions. And these are actually generated by AI. So what I did was I asked AI to give me the top 10 most asked questions. It gave me the questions and it gave me some answers. I'm going to give you the questions. I'm going to then read you the AI answer, and then I'm going to give you my answer. So we're going to see both of those. All right. So as always, we have Monica Wyndham with us in the background. She's going to be on chat. Monica is a wealth of knowledge in multifamily asset management. So if anybody has any questions along those lines, certainly reach out to Monica. As always, please tell me who you are, where you're from, where you're coming in from, what city you're in. Say hi over in the chat. And we're going to get it going here in 1 second. Let everybody get in. All right, so today we're going to be talking about the top 10 most asked multifamily questions. All right, disclaimer, these were generated by AI. I'm not going to promote any particular platform, but I'll go ahead and tell you it is the real common one that's usually on most people's desktop, right? So what I did was I took the program and I said, give me the top 10 most asked real estate questions or multifamily questions from investors. And he gave me the top 10 questions, and then he gave me short little answers for each question. So what I'm going to do in this video is I'm going to read you the questions, and then I'm going to read you its short answer, and then I'll give you my answer. So according to the internet and the AI, this is the top 10 things you all want to know. All right, so here are the top 10 most common questions investors ask about multifamily real estate. How do I find good deals? Well, I couldn't have guessed that one being the first one up, right? So number one question we have, how do I find good deals? Computer answer, utilize online platforms, local real estate agents, and networking within the industry. Okay, that's pretty good answer there. What I always tell everybody, there's only two ways to actually find deals. Now, there's a difference between deals and good deals, right? But there's only two ways of finding deals. That's either directly through an owner or going directly to an owner or working with a realtor. Those are the only two ways. Realtor, direct to owner, right? So we always want to be working on our relationships with realtors. I tell all my students, you're trying to buy real estate that is not for sale today. That means you're trying to build a relationship with the realtor, wait for a deal to show up, maybe next month, 2-3 months from now, and you're on that realtor's short list, right? They call you before they call me or Monica or anybody else, and that's where you get good deals. So relationships with realtors is my answer for number one. How do I find good deals? And that's going to be if you're looking at stuff maybe 40, 50 units and above. You're very much in the commercial realtor space. If you're less than 40 or 50 units, then my answer is a little different. You can do both of kind of what the computer here says. Go directly to an owner. That's going to be direct mail, direct contact, phone number, calling up owners and seeing if they want to sell. I've done a lot of that. Nothing wrong with that. Or working with realtors, right? That's going to be MLS, small, I won't say small realtors, but more small firms, single family realtor, non-commercial realtors. Those are great places to find, from 2 to maybe 20, 30, 40 units. Above that, you're probably with a commercial realtor. All right. Number two, what is a good cap rate for a multifamily property? I hate this question. All right. The computer says the ideal cap rate varies based on location, property condition, and market trends. So basically no answer. Generally, a low cap rate indicates a higher property value. All right. So what's a good cap rate for multifamily property? First off, we have to understand cap rate is several things. One, not enough information. I always tell everybody cap rate is not enough to simply purchase a deal or not enough to say it is a good deal or bad deal based on that alone. Two, cap rate is price or value divided by the net operating income. All right, if we say price divided by the NOI, then what we're calculating is our purchase cap rate. If we say the value, which means just sort of what we think it's worth in the market, divided by our NOI, then we have a market cap rate, right? So there's a difference between market cap rate, that's sort of what everyone in the area is paying per hour cap rate right here, right now. That's our purchase or sale cap rate, whatever the case. All right, so what's a good cap rate to buy a property at? Well, as high as possible. What I will remind you is that when cap rate is below interest rate, it will not cash flow. It's a very important comment, right? So if you have interest rate or cap rates, right now on an asset that are less than 6.5 as of this afternoon, yeah, your property's probably not cash flowing, at least not if you're trying to refinance or buy or purchase. So that's my answer. Is a good cap rate is probably going to be about 2 points higher than whatever the interest rate is in the market. That is my personal rule of thumb. So whenever you're looking to exit a deal and you say, what is my exit cap rate going to be? Well, you're really asking, what is the future interest rate going to be? If you think the future interest rate when you get ready to exit is going to be 6, then you better bank on your property exiting at more like an 8 cap or something like that. Because again, if you exit at a 6 cap rate, or you're expecting to get a 6, and the interest rate is at 6, when you go to exit in a few years, you're selling a property that won't cash flow. That probably won't be very attractive. All right, number 3, how do I calculate the ROI on a multifamily property? ROI is calculated by dividing net profit by total investment. Okay, that's a pretty bland answer. Return on investment is what we're talking about here. Well, I would tell you, not a good enough question here. We want to know what kind of ROI. There's lots of different ROIs, and there's even ROE, right? Return on effort. So we have return on investment. That's how much money are we making on our dollars invested in the deal? And then there's ROE, which answers the question, is it even worth it? Right? So I might go in and get a 10% return on my money, but if it only turns out to be a few dollars in actual cash money, that really may not be very interesting to me at all, right? So that's what I'm saying. You want to really pay attention to all the different types of ROIs. First off, let's say cash on cash. That is the return on investment produced by positive cash flow. I'm going to say, again, you probably want to be a little above interest rate for this one. So 6, 7, maybe 8, somewhere in that range would be my opinion. I'm not giving anybody financial advice here, just saying that's kind of what works for me. All right, as far as IRR, that's internal rate of return. I'm not going to go into that formula. It takes a calculator. Internal rate of return is sort of your overall, how much money are you making on the deal. I would say you want to be above 17%, maybe 18, 19, 20%, somewhere in that range. But it also depends on how long you're holding the asset. So it's a pretty roundabout question there. How do you calculate ROI? Again, simple answer there, you would just take the profit and divide it by all the money you put in the deal. There's your ROI, but I don't think that's a very sophisticated question or answer, really. All right, number 4. What are the key factors to consider when evaluating a multifamily property? Again, a very broad question there, where the key factors to consider when evaluating multifamily property. The computer says location, property condition, rental income, expense, and market demand. Yeah, I certainly agree with the first two. Location. Yeah, you really want to pay attention to that. Location has a lot to do with appreciation, right? So if you're in an area that does not see a lot of appreciation, your exit strategy could be difficult, right? If anybody says that you make money when you buy, they're wrong. They're absolutely wrong, right? You make money when that asset goes up in value, you exit, you put money in said bank account, and the property is sold. Now you've made money. Don't count those dollars before they real estate hatches. All right, so other things to consider: property condition. Yeah, if anybody follows me at all, I'm always beating on the capex drum. Older assets, 1960s, 1970s assets, especially in multifamily, are reaching their physical obsolescence. Most buildings were built to last about 60, 70 years or so. Plumbing, wiring, all that kind of stuff. 40, 50 years is pretty average for the life expectancy of that infrastructure. All of it's starting to age out right now, and you're really going to have a lot of capex going forward. So I would say location, capex, and then, it says here rental income, expenses, and market demand. Well, that would be your underwriting. I would say the income and the expenses certainly falls into your general underwriting of the deal. All right, number 5, how do I finance a multifamily property? With money. Answer here is options include traditional mortgages, private lenders, and commercial real estate loans. Money. Right. So how do you finance a real estate multifamily property? All right. Well, clearly money is value. Let's do that, right? So if you're going to go to a bank and you're going to borrow money, you're going to need to put some money down, you're going to borrow money, you're going to buy the deal. Fine. We all understand how to do that. Raising the money, things like that. If you don't have it, syndication. That's not about this call today. We can discuss that another time. But that's the most common ways. And then lastly, I would say creative financing. That's the answer they're not really giving you here, is to use creative financing. I have a book on this on Amazon, Creative Cash. So use creative financing when you can, but the key there, as I said, money, is you have to have something to trade. So whenever you're going to try and use creative financing, you got to have some kind of value, right? You have to bring something to the deal. So if you don't have money to bring to the deal, you still have to bring value. So that's some sort of problem solving value you're going to bring to that seller. So if you don't have money, be valuable. All right, number 6, what are the ongoing costs of owning a multifamily property? Well, I'll start with gray hair. You can see a few here. This says property taxes, insurance, maintenance, utility, and property management fees. Well, duh. Okay, so yeah, ongoing costs of owning a multifamily property. This is a pretty straight answer there. Ongoing costs of owning a multifamily property, it's hard to say really. Again, it depends on whether the asset was purchased right or not. If you bought at a low cap rate, see question 1 and 2 back there. If you bought at a low cap rate on an older building, then I think the ongoing costs of owning that multifamily property are going to be life expectancy for yourself. It's going to be quality of living, quality of life. You're going to be a slumlord. You're going to be dealing with that. You're going to be dragging this home and dealing with it, and you're going to have capital calls and all this kind of fun stuff. So that's one cost of owning a multifamily property. Another cost of owning a multifamily property would be it's more work than you might think. That it's maybe a little more stress, maybe it's a little less passive. Let's say that it's less passive than most people think. A lot of people think, being a general partner, finding the deals, kind of being the asset manager, that's ultimately going to be passive. That is not passive. So I'd say number 6, what's the ongoing cost of owning multifamily property? Could be life, enjoyment, right? We'll say that if you get the wrong deal, I'll put it that way. All right, quality of life, that's what I'm trying to say. How do I deal with tenant issues? Number 7, how do I deal with tenant issues? Well, that's a pretty broad question. How do you deal with tenant issues? Number 1, hire a management company. Do you want to be answering this question? I would ask that question first. Do you want to be dealing with tenants? Now, if you're a manager and you have to deal with tenants, or you are a small owner of assets, you don't have a giant property, and you don't have a lot of management, you have to deal with it yourself. That's where I got started. Then you have to deal with the tenants. But first off, I would say be careful about what you purchase. Be careful about your deal analysis, right? You want to look at deals and factor in third-party management and its expense for any deal you ever analyze. That way, when you need third-party management, your budget is always there for that. So I would really say, how do you deal with tenant issues? You probably should be allowing the property management company to deal with that. If not, if you are the manager, you're dealing with it, then my very direct answer would be immediately familiarize yourself with fair housing law. Stop this entire conversation. Go get educated on fair housing. Don't start making mistakes and breaking laws. In dealing with tenant issues, there are very smart and devious tenants out there that know how to manipulate you into saying and doing the wrong things. They know how to pull the right levers. They know how to do the wrong thing, the right things, the wrong things, and get you to do stuff so that they can sue, so that they can take advantage of the court system, so forth and so on. Monica and I could sit here, probably write a book on just those kinds of stories. So how do you deal with tenant issues? Either management company or immediately become educated in tenant law. You can always look up the tenant landlord handbook. So type that into the computer, into the search, and put in your state or city. So, where I would put Florida tenant landlord handbook. Type that in and you can go ahead and probably find pretty much everything you're looking for right there. I did not give you the computer answer. Computer says, develop clear lease agreements. Okay, I agree. Have effective communication policies and address issues promptly. Okay, number 1 is good there. Yeah, do have a clear lease. I didn't think of that. That's a good answer there. What are the tax implications of owning multifamily property? Number 8. All right, well, I'm not an accountant, so I can't directly answer that with any real authority. What are the tax implications of owning a multifamily property? Well, I'd say that depends on whether you make money or not. Pretty much the tax implications of anything in America. If you make money, you're going to owe some taxes. If you don't make any money, you're probably not going to owe any taxes. So let's start off with being profitable when we invest in multifamily, and we'll worry about paying taxes some other time. That would be my advice. You can get into things like a cost segregation, right? That's doing hyper accelerated depreciation on a building. You can look that up. I'm not going to bore you with that today. The computer says consult with a tax professional to understand deductions, depreciation, and potential tax strategies. Yeah, that was just a big not going to answer you directly kind of answer there, wasn't it? That's a CYA answer. Number 9, how do I value a multifamily property? Well, that's sort of a combination of number 1, number 2, and number 3 up there. So I'd refer you back to that. How do you value a multifamily property? Well, cap rate. Well, let me give you the very straight answer. There are 3 ways: income approach, the cost replacement approach, and the comparable sale approach. That's how you evaluate a real estate deal, right? 3 ways: cost approach, income approach, income approach, cost approach, and the comparable sale. Gosh, I'm drawing a blank there. Comparable sale approach. What is everybody else paying for the asset, right? So those are your 3 ways technically. I would say you want to lean heavily on comparable sale and income approach for that one, valuing a multifamily property. But you want to use data going forward and not data looking backwards. So today I would be careful about looking at comparable sales, because if those comparable sales came from a year or 2 ago, I'm afraid that data might not be valuable, right? People overpaid over the last couple of years, and it looks like values are starting to fall a little bit. So I would be looking forward with the how do you value a multifamily property. I would say by looking out 2, 3, 4 years and trying to figure out what you think that thing's going to be worth. Computer answer: use methods like comparable sale analysis, income, capitalization, and cost approach. I wasn't even looking at that. There you go. So that tells you the direct answer. Looks like I'm right. Number 10, what are the risks associated with multifamily real estate investing? See answers 1 through 9. Market fluctuations, vacancy rates, unexpected maintenance cost, and regulatory changes. That is the computer answer. What are the risks associated with multifamily real estate investing? Losing money. That's the biggest one, isn't it? And mostly losing money, right? Going into foreclosure, something of that effect. That's what I would say probably the biggest risk. Now, there are lots and lots of risks. I mean, obviously, it's a risk walking outside your front door, but the most common are going to be losing money, right? There are only 3 ways you can exit a deal. You're going to sell it, you're going to refinance it, or you're going to lose it. Those are the only 3 ways anybody exits a deal: refinance, sell, foreclosure. So in the refinance, you may or may not make money. In the sale, you may or may not make money. Either with those, you're not going to lose money, right? But the foreclosure, obviously, you lose money. So there's your risk there. All right, so that's what I have for you. Those are the 10 most asked questions out here in chat world. All right, now that I'm not reading the questions, I'm going to jump over here and take a look at all the conversation we have over here. Great to see everybody. Thanks for stopping by. Let's see if we have any questions we can ask. Josh, good to see you. Anthony, everybody, Rodney, Josh, awesome. Yeah, Josh says he's stressing everything on an 8 cap exit. I agree. That is going to absolutely kill some deals. It's going to be very difficult to buy deals, at that kind of or today's cap rate and then exit at an 8 cap without owning the property for 20 years, right? But I absolutely agree. So if we're going to exit at an 8 cap, that means you better be buying at a 6 to 8 cap yourself to be able to make money in the next couple of years. Excellent. Good to see everybody. All right. So yeah, thank you again, Creative Cash. Yeah, that's the book on Amazon. You can check that out. Tieran from we got South Africa in the house. Tieran, good to see you, man. Rodney, when approaching a bank to finance multifamily property and you're not trying to do a syndication but a JV partnership, what is the point of a sponsor needed for their experience and liquidity? Yes. If you're trying to purchase a 10 versus 100 unit. All right, Rodney, you pretty much answered the question there. What Rodney's asking is if you're not doing a full-blown syndication, just some other structure like a JV, or maybe even you're buying something yourself or whatever the case, why would you need a sponsor? All right, first answer is probably going to be the one you put here, the net worth, right? So it would depend on the type of loan that you're getting, but a 10 unit, maybe upwards of 10, 20 units, something like that, is probably going to be a pretty straightforward debt service ratio commercial loan. Therefore, they're looking at the debt service ratio. They're looking at the income of the property to decide the loan, to make sure it's going to pay its loan. They're not looking at your W-2, right? So if you go out to buy a house, a car, something like that, that's consumer lending. They're going to look at your W-2. They're going to say, all right, Mr. Johnson, do you make enough money to afford this car, this house, whatever the case? They're going to look at an appraisal, you get a loan. See, over here in commercial world, they're going to say, all right, did the property appraise? And does it make enough money on its own, the 10 unit, the 100 unit, whatever the case, right? But then they're going to say, is Rodney worth suing, right? Is this borrower worth suing? And if the answer is no, then the borrower is not a risk, not risk reward, right? They won't give you the money if they can't come hurt you over it. Now, if there's any bankers here, you know what I'm talking about, but they won't actually put that into words, but that's it. A bank is not going to give you something they can't sue you over. They want you to have net worth equal to or greater than loan amount, and that's why a sponsor. So, if they say, well, gosh, Rodney doesn't have any money or Bill doesn't have any money, we're certainly not going to lend, $10 million to somebody who doesn't actually have any money. That would certainly not be a very safe thing for them to do. And you say, yeah, but hold on, the property is guaranteeing the loan, right? I mean, wouldn't they just come take the property in a default? Yes, but what if the property value declines? What if we go into a down cycle, something happens, property blows up, who knows what, right? They want to know that there is a warm body backing up that loan that they can come and get. So that's why the main answer, you would want a sponsor in there. And then your second, you've put here liquidity and or experience. Depending on the size of the property, right? 10 units, they're probably not going to beat you up too bad on experience. You with some lower experience could probably get that. But if you've never done real estate before and you walked into a lender's office and said, hey, I'd like to, apply for a loan on 100 units, they're probably going to have a real serious issue with your lack of resume there. So that would be another reason. I have actually joined people in their deals because I did bring the resume that they needed to get the deal done. So I have done that. And yes, that is absolutely possible. So those are the main reasons you'd probably want to get a sponsor, something like that. Net worth, liquidity, stuff like that. So excellent. All right, that's kind of the questions from the internet. Again, those were produced by AI. I was curious to see what they would say, and that's what apparently everybody out there is asking. I thought those questions were, quite frankly, pretty general. They don't seem like those are very high-level questions, but I guess that's what the general world is asking, and that's why we have those questions there. AI wrote some pretty terrible answers, I would have to say. So yeah, be careful about using AI to write your content and things like that. Probably going to write you up some garbage. But anyway, there you go. Hope some of that helped. Hope those were some good answers in there. You learned something. If anyone has their own question, not AI generated, they would like for me to answer, certainly post it in here. Monica and I are always monitoring the chat here. We'll come back in and answer any questions. Again, I want to remind everybody, I'm always in here Wednesday, 2 o'clock. Every week. If for some reason I can't be in here, I'll just post that I'm not going to be here. I don't really send out very many invites because Facebook's been getting on to me about inviting people. So you just kind of have to set your own calendar. Share the group, share the link. Appreciate everybody stopping by, and see you next week.